Jay and Denny are approaching the stage. Come on up, guys. Charlie, is this the little clicker thing? Just this thing right here?
Yep.
Or right here?
Straight ahead.
Right there?
Yep.
Okay. I didn't use the clicker thing yet. Gee whiz, if we have those two guys on Twitter, then we'll put Charlie on Twitter, and we'll see what happens. You know, if Kim Jong-un is on Twitter. Oh, you don't know what Twitter is? No. Okay. So the Q&A is, like I mentioned, the top 4 questions we've been getting from clients. We're going to cover those, and then we're going to open it up for questions. So first, we've been getting a lot of questions about the Fed, what the Fed's going to do, are interest rates going to rise, how's that's going to affect our portfolios. Jay runs millions and millions and millions of dollars of bonds for our clients at Fort Pitt Capital Group, both corporate bonds and municipal bonds. So we rely on Jay to give us rousing opinions about the Fed and select good bonds for our clients. So Jay, we're going to pitch it to you. What did the Fed do last year? What do you think is happening with the year ahead?
Sure. So before we get into 2018, we'll just do a little revisionist like Charlie did in the stock market of what happened with the Fed last year. And the Federal Reserve, we'll take a step back. The Federal Reserve, what they do, they control the interest rates for short-term investments. In layman's terms, what that means for the investors, such as yourself, is as the short-term rates go higher, you finally can make a little bit of income on your CDs, your money markets, your corporates, and your shorter municipalities if you could find those. So after 8 years of having a 0 Fed funds rate, which basically gave you 0 on any of your money that was sitting in money markets, they finally started to move rates higher into normalized rates to a point that we could finally make some money on the short end of the curve. So they increased rates 3 times in 2017. And that put us at a rate of 1.5 at the end of the year. And that's very meaningful because, like I said, we're finally able to capture some of the interest rates on the short end of the curve. Now, what Charlie was talking about with the longer end of the curve is very important because what that'll do is if rates go too high, you have another alternative from stocks to go into bonds. And that will be negative for the equity market. But we don't anticipate that to happen. In fact, I think there's a graph that shows what we've seen in the short end. You can see in the short end of the curve where we started, the blue line, and then where we are right now, a year later, the darker blue line that has the bigger dots. It shows that there's a 78 basis point increase of interest rates in the short end of the curve. And that's extremely helpful because, again, you get a higher interest rate on your CDs and money markets. But if you go to the longer end, you see on the 10-year, there's only a 17 basis point difference. And that's meaningful because they don't go together. Just because the short end is rising doesn't mean the long end is going to rise. And what Charlie was talking about, the breakthrough of the interest rate was based upon the 10-year, which is the benchmark interest rate. So that is the one we sort of have to keep a look on to make sure that it doesn't break through the level and get too high. Because that'll mean that we have inflation that the Fed wasn't able to control. So back to the actual initial question, what do we expect in 2018? We're expecting 3 more Fed tightenings, interest rate rises. So that'll put us at 2.25 by the end of the year, which is a lot better than what we've seen at 0, but it's nowhere near what historically we've seen with the Fed funds rate. The Fed has done a wonderful job of telling us what to expect, so the market hasn't been surprised by any moves. They've given us a lot of ample time in order to make our investment opportunities to coordinate with their Fed funds move. And they've been talking about 3 increases, so I don't see deviating from that point.
Thanks, Jay. Appreciate that. Okay, next. Well, Charlie was getting there a little bit, but with all the stuff that we see on TV every day from the political environment in Washington, D.C., a lot of folks are saying, how are politics influencing the portfolios? How are politics going to influence the market? How does that affect what you guys are doing? So, Charlie, all right, Mr. Politics, it's all you.
Okay. We don't spend a whole lot of time paying attention to the circus in D.C. We do pay attention very closely to what the cabinet is doing and what Congress is doing in terms of changing laws. And the key change that happened in 2017, obviously, was the Tax Cut and Jobs Act, tax reform. That was we like to say something important in the markets happens 2 or 3 times a year, and you just need to pay attention to that. Well, that was one of those times. The tax law, I've been listening to corporate conference calls here as the fourth quarter earnings are being reported, and almost to a company, every single company is reeling off a litany of benefits to not only their profitability, but to their potential investment spending here in 2018. So we are paying attention to the material changes that matter to business because we own portfolios of businesses. And so that was the key change that happened at the end of 2017. That's going to make a material difference in the economy, we believe, and corporate performance here in 2018. But as I also said, a lot of the good, we believe, has already been discounted in share prices. As everyone knows, the market is a forward-looking animal, and markets are discounting 6, 9, 12 months ahead. And so we think a lot of the good news that's to come on the economic side here in 2018 has already been reflected in prices. So that pretty much sums it up.
Okay, thanks, Charlie. Next, what we've been hearing from clients, why did the international market do so well last year, and what do we expect for this year? Just when folks are ready to throw in the towel on a certain market sector because it's not keeping up with some other market sector, we get great results. Denny Bache heads up our mutual fund research. Denny manages millions and millions and millions of dollars in mutual funds. I think we're at 700 or 800 million now. So Denny, you do a lot of work on the fund accounts and you look at all market segments. What do you have to say about international investments?
Yeah, international equity markets performed very well last year. In fact, if we go back to the beginning of 17, valuations were very attractive. Global growth was improving. We had seen consumer and business confidence was rebounding. And also we saw throughout 2017 a currency effect. A lot of the major currencies around the world were strengthening against the U.S. dollar. So that was a big factor in the international returns. And as you can see right here, the 2017 returns for the MSCI EFA, which is International Developed Countries, was 25.03%. The MSCI Emerging Markets, which is developing countries, was up 37.28%. And this is the first year since 2012 that these two indices had beat the S&P 500, which was up 21.83. So what do we see for 2018? We see, obviously, valuations have come up some, and there's always geopolitical risk involved, whether it's Great Britain leaving the European Union or the instability in North Korea. But this year we see economies of the world continuing to do well. We see global growth continuing to grow. In fact, the IMF has come out this week, the International Monetary Fund came out this week and upped their forecast for global growth to 3.9%. So, obviously valuations are not where they were, so we don't expect the big returns from last year. But, what we strive to do in the asset allocation portfolios is to build broadly diversified accounts that buy U.S., that invest in U.S. and non-U.S. managers, that buy large cap, mid cap, and small cap companies. And on the fixed income side, in the asset allocation accounts, We mainly use U.S. fixed income investments, but also complement those with high yield bonds and also some international bond fund managers. So, the goal really is to help grow your wealth and or preserve your wealth over the long term and over time.
Thanks, Denny. Very good. All right. So this question we get every day. The market's hitting all-time highs. What are we going to do to protect the portfolios? Is the market going to crash? I'm scared. I'm at home. I'm by myself. Please help me. Charlie,
Really, Mike?
what are we going to do?
Wow. Well, let's step back a little bit from the ledge, I guess, and think in terms of what we're trying to accomplish and the portfolios we put in place to accomplish those goals. Everyone here has a set of goals they want to accomplish. They have a risk tolerance. We build a portfolio that's designed to fit your risk tolerance. We build a plan for you. And so everything we do is designed to work to that plan, and the portfolios that we build have buffers built into them. Value, number one. Everybody here who's heard me talk more than once knows that I'm an old Scotsman and I want to buy a business as cheaply as I can get it. And so the businesses we put in your portfolio have price-earnings ratios or valuations typically 30% less than the market. So when the market does decline, they don't tend to decline as much. That's one way we sort of build a buffer in against a negative outcome, so to speak. On the bond side, Jay is looking at quality. We always want to have quality businesses where we can be certain we can get our money back. Diversification. Denny just mentioned how diverse our portfolios are domestically, internationally. So these are sort of the three of the cardinal rules in investing in terms of reducing the risk in the portfolio, and we're doing all of these. When you layer that on top of a plan which allows you to have cash set aside for whatever cash flow needs you might have over the next year, 2, 3, 4 years, that builds in an approach that prevents us from doing something stupid when the market declines. Because the last position you want to be in is in a position of having to sell something when the world goes haywire. And so everything we do is built to avoid that eventuality. Okay?
So no market timing.
None.
Nope.
Can't do it.
Ain't doing it. Okay?
Yeah, Mike, we're not doing
Ain't
it.
doing it. We are going to, we're going to take some questions from the audience. And we've got some folks. We've got, I think we have 4 mics. We got a mic over here and a mic here and a mic there and a mic there. So if someone has a question for the panel, just raise your hand and we're going to get a mic to you. Shiv, right there. Here comes Daryl with a mic right behind you.
Here you go, Daryl. Thank you. Daryl is who I work with, so thank you, Daryl.
Yeah.
I have a question. Secretary of Treasury Mnuchin and Donald Trump, do they talk to each other? Because one says we want to keep the dollar lower. Trump says, well, we want to keep the dollar value higher. Would that impact our dollar as the world reserve currency? Question to Charlie.
Okay, Charlie.
Jay, I think Jay can.
Yeah, that's actually a good question. Charlie and I were talking about that today. I don't know if anybody saw the preview of the interview that President Trump is having with CNBC tomorrow. I think it's like 6 o'clock in the morning. Set your DVR. But they were talking about the dollar and how Mnuchin was talking it down. And if you read the transcripts of what Secretary Mnuchin said, it's as clear as day, said that there are positives to having a weak dollar. However, there are negatives to having a weak dollar as well. The part that the press picked up was just the first part. They didn't bother to tell you that he said there's a negative part to that as well. So I think what President Trump did today that you'll hear tomorrow was basically say that he shouldn't be talking about that. the dollar should represent the strength of your country. We're always getting on China's back and saying, you guys are devaluing your currency, you're manipulating your currency, and then we have people coming out in the Treasury and manipulating the currency. I don't believe that was done on purpose. I think he was just asked a question, and he said there are positives and negatives to having a weaker dollar, and the press ran with half of it instead of the other. But it's probably a learning experience that he just don't talk about it. Let the economy speak for it. If you have a strong economy, you should have a strong dollar.
And that's what Trump said this afternoon, essentially. He came out and said the dollar will get stronger and stronger, and the entirety of the decline that we saw in the dollar yesterday was earned back today when Trump made that statement. I think that says more about the way our markets work, by the way, than any fundamental change in the currency. We have algorithms, numbers I've seen between 35 and 40% of every dollar traded on the New York Stock Exchange is done by a robot. So headlines like that generate volatility. When machines can trade without human intervention, that's what you get.
We have a question. Thanks. We have a question right here. Warren.
What are your thoughts if Donald Trump excuses himself or gets excused out of office in 2018?
Oh, I'm not answering that one.
Well, it would be a significant risk for the market if it happened. I can't quantify it. Given the fact that the S&P 500 since Election Day 2016 is up nearly 50%, that would tell you that's a material risk. Whether the risk is high that it actually happens, I don't think so. As I said before, his volatile personality, his narcissism, his inability to accept even the smallest slight angers a lot of people, but in terms of the broader effects on the fundamentals of the U.S. economy and the markets, I think it's a lot of noise. As I said before, 85% of what he says never comes to fruition. So I think it would be a risk if it happened, a significant one, but I think the odds of it happening, I mean, we have a concerted effort by one of the wealthiest Democrats in the country, Mr. Steyer in California, to fund a impeachment proceeding. And it really has not gotten traction. I've been hearing that there are members of the Democratic Party, Pelosi one of them, that have told Steyer to stand down, that they really don't think that's going to get anywhere. But it's fascinating to me that we're talking about impeaching a president who's now been in office for a year, and it just doesn't go away.
Another question? We have one here and then back here.
I guess. I know that with trade, with protective tariffs have been recently announced, and also the falling dollar, although that may have changed today. That seems like it's policies going back to the 1920s economically. I was wondering if Charlie or someone could comment on that, and what does that portend?
The dollar weakened all of last year. First significant decline in the value of the dollar in several years. I don't think we're headed back towards a beggar thy neighbor policy of competing currency weakness. I think in some sense we've already been in that environment, given the fact that central banks around the world are cranking out euros, dollars, and yen at historic rates already. So if anything, we've already seen the debasement of worldwide currencies already, and I don't really see it getting a whole lot worse. And I think fundamentally the gathering strength in economies everywhere, Japan, Europe, and the U.S., is going to take the attention of the policymakers off the need to further debase their currencies. And we can already see that in the beginnings of the change in policy of the central banks in terms of reducing QE. So the beggar their neighbor approach, where countries are aggressively trying to drive down their currency, I would see that more in a period where recession was on the horizon rather than a period like today where looks like we have a nascent good period of growth.
Question back here in the back, I think.
What effects are Bitcoin and cryptocurrency going to have this year?
Where's Kim? Kim Forrest is our senior research analyst. She's also our TV star. And Kim I remember it was a few years ago we did a newsletter on Bitcoin, and a very popular topic right now, and Kim has done a lot of work on that. So Kim, would you mind answering that question?
Sure. So I guess I have a question for you. Do you mean, would Bitcoin have an impact on the economy, on the markets, or just what is going to happen with Bitcoin in general?
I think on the market more than anything.
Okay. So I don't think Bitcoin is big enough at this point or at any foreseeable future to drain money out of the market and into Bitcoin. And I'll tell you why. Let's talk about what Bitcoin really is. Wait, I have to step up here. I'm hearing myself kind of. Okay. So Bitcoin was this software created to facilitate peer-to-peer exchanges of money. Okay? So kind of like instead of using a credit card on eBay, you'd use Bitcoin. And it really never caught on except on a very tawdry website, and that was shut down. But people found out about Bitcoin, and this is kind of an enthralling idea that you don't need an intermediary, that this is just a whole bunch of people like you that are facilitating exchanges. So what happens when you buy a Bitcoin? Where does the money go? It goes to the person that sold you the Bitcoin. So a Bitcoin has no inherent value. It is only a mechanism of exchange. But here's the thing. It's being used as a store of value, right? Because people are just buying it up, buying it up, buying it up. And how did it get there? Well, I strongly believe that mainland China, or the communist China, was really cracking down on currency leaving the country, and this was a mechanism to get money out. And so people just kept bidding this up because, again, the only value that it has is supply and demand. That's it. So as people were demanding more Bitcoins, people were saying, sure, I'll sell it for you for $10,000, $11,000, $16,000. So I think the mania is going to calm down. There's not a whole lot of businesses that legitimately want to take Bitcoin given the volatility of the value, because it's set by supply and demand. And finally, I'm thinking the tax man really doesn't like Bitcoin, and there's going to be some legislation coming out. Just saying. Because, the government do take a bite. So does that answer your question? Okay.
Thanks, Kim. We appreciate that. I got a question over here. Ed?
I think this question is for Jay. I listen to a lot of podcasts, and my favorite is Planet Money on NPR. They had a recent episode which said when the yield curve goes negative and long-term rates go below short-term rates, it's an indication that the economy is in trouble and business is going to, economy is going to go down. And I couldn't see all the numbers on your chart, but it seemed to me that's what you were showing, is that long-term rates were below short-term rates. So the questions are, is that what you were showing? Is the yield curve flattening out or going negative? And do you think that's an indication, if it happens, that the economy is going to go south?
Yep. Historically, what you just mentioned is correct. When you get into what they call an inverted yield curve, when the long end is producing a lower yield than the short end, historically a recession follows in the preceding 12 to 18 months. We're not at that point. We are at a flattening of the yield curve. When the long end isn't moving anywhere near as much as the short end. It's like a seesaw. We're seeing it's starting to flatten as the short end goes up, but we haven't seen the inversion. And there's nothing on the horizon. I mean, Charlie can attest to this, that would show that a recession is imminent. I mean, we would have to have some sort of warning signs that was going to happen, and I just don't see it at this point. The inversion of the curve alone doesn't necessarily mean 100% that we are going to go into a recession, but it is a great indicator that is going to happen. You also have to remember, too, that we started at zero, so on the short end. So we are going to have a flattening of the yield curve just naturally because the beginning point was zero. So we have to normalize somewhat in order to get back to where we were in the past, to make sure that we have ammunition in the economy, that if we do get into a recession, the Fed can act appropriately.
When you can end the Q&A on a yield curve question, it's a great night, okay? Yield curve. So, we appreciate your questions. Here's what we're going to do about the food and drinks. And Jay, that yield curve thing, I don't even understand it. I've been in the business for 30 years. So, while we're waiting for the staff to bring the food out, we're going to have a lot of past hors d'oeuvres, and the service staff is going to release tables to the buffet once everything's set up. So hors d'oeuvres are coming your way. You can hit the bar on your own. We're going to do this in an orderly way because of the fight we had last year when the police came over the turkey. We're not doing that this time, okay? So thanks to the panel. Thank you very much. Thank you. Thank you all for coming. We love you guys. Can't wait to see you back here next year. Thanks very much.